Welcome to The Explainer. Today, we're going to tackle something huge. We're breaking down two super powerful tools that traders use to find some real clarity in what can be, let's be honest, pretty chaotic financial markets.
All right, so let's jump right in and start with the fundamental problem that really every single investor faces.
You know, when you look at a typical price chart, it's a mess, right? Just this noisy, jagged line going all over the place. So, the big question, the one we all have, is how in the world do we turn all that noise into a signal we can actually use?
Okay, let's dive into it. I want to introduce you to the very first tool in our Clarity Toolkit.
This is the Simple Moving Average, or SMA for short. And you know what? It's designed to do one thing, and do it brilliantly. It just filters out all that day-to-day noise by showing you the average price over a certain period. Simple as that.
And wow, just look at the difference here. I mean, this is the magic. On the left, you've got that raw, totally chaotic price action we started with, but then on the right, that smooth SMA line just cuts right through all that mess and shows you the market's real direction. It's so much clearer.
Now here's something you've really got to remember. The SMA is what we call a lagging indicator. Because it's based on past prices, it's always going to be a step behind. It confirms a trend that's already started. It doesn't predict a new one. And that's super important. It makes it great for confirmation. So we found the trend. Awesome. But, and this is a big but, knowing the direction is really only half the story. So let's move on to our next tool and see how we can build on this.
Okay, so now that we know the trend, the next question is, well, how wild is the ride going to be? Is the market just kind of chilling, nice and stable, or are we strapping in for a roller coaster?
And this is where Bollinger Bands come into play. They are just awesome. They're designed for one specific job, to measure that volatility by creating this dynamic channel that wraps right around the price. So how do they work? It's actually pretty cool. Right in the middle, you've got a simple moving average, just like the tool we already talked about. And then you have these two outer bands. They're calculated using something called standard deviation, which is really just a fancy way of measuring how far the price is straying from the normal or average price. Okay, check this out. When the market is quiet, when it's calm, the bands get really narrow. They squeeze together, and traders call this the squeeze. It's a huge tell because this often happens right before the market makes a big, explosive move. And then the opposite happens. When volatility really picks up, the bands expand, they get wider, giving the price a lot more room to bounce around. I love this analogy. Think of it like a calm river suddenly hitting rapids and widening out. That's exactly what's happening here. So you can think of these outer bands as like dynamic levels of support and resistance. They're not static lines. When the price hits that upper band, it's often considered overbought, like an elastic band stretched to its limit. And when it hits the lower band, you guessed it, it's seen as oversold. It gives you these potential turning points. Okay, so we've got the SMA, we've got Bollinger Bands. They're both really useful on their own, for sure. But their true power, well, that's unlocked when you put them together. And this is where it all clicks. It's like a 1-2 punch. The SMA gives you the what. It answers that big question, which way is the market going? But then the Bollinger Bands come in and give you the how. How stable, how strong, or how stretched out is that trend? It's a perfect partnership.
So yeah, just to hammer this home, the SMA shows you the direction. The Bollinger Bands provide the context. It's that simple. And when you combine them, you just get this much richer picture of what the market is actually doing.
Okay, let's look at a practical example. Say we're in a nice, strong uptrend. First, you'll see the prices trading above that middle band SMA. That confirms the trend. Then you might see the price walking the band. That's what traders call it when it consistently touches that upper Bollinger Band. That's a huge signal of strength. So if you see a temporary little dip back towards the middle SMA, that could be a really great opportunity to jump in before the next move up.
All right, let's put it all together. What is the big takeaway here?
Look, when you combine these two ideas, trend and volatility, you're not just guessing anymore. You're not just throwing darts at a board. You're using a real, systematic approach to actually read what the market is telling you.
And you know, one of the best things about this whole setup is how versatile it is. This isn't just for one type of trader. You can adapt this for super short-term day trading, for medium-term swing trading, or even for your long-term investing strategy. It's an amazing toolkit.
So here's the bottom line. These tools, together, they give you an incredible map of the market. They really do. But
A map is completely useless if you don't have the discipline to actually follow it. Which leads us to our final thought, the most important question you have to ask yourself.